So Keegan, yeah, I mean, as you say, I mean, last year there's no getting away from it. It was a tough year. Whatever way you want to look at it, the number of factors that kind of went against us, whether it was interest rate rises, inflationary concerns, and obviously growth stocks being very much out of favor. I mean, that was what the market was really, really focused on. But I think what's interesting is if you take a step back and actually look at some of our biggest holdings in 2022, like there was pretty significant progress made across a number of our companies. And really, we think this is really what the market overlooked. So whether it's, Moderna, which is obviously our top holding, announcing what we think was absolutely game-changing development with their personalized cancer vaccine, the potential to reduce recurring cancer or death by 40% in conjunction with another drug is phenomenal in terms of what impact that could have. Tesla itself, orders are currently running at 2 times production. They built just under 1.5 million cars in 2022, probably one of the strongest operating margins we've ever seen from an OEM manufacturer, about 17%. They're on course to probably produce about 2 million cars, this year. So the progress at Tesla, continues. Moving on to a couple of the unlisted holdings, which are in our top 10, Northvolt, which is the lithium-ion battery company, is now sitting at a 55 billion order book. That's kind of double what it was the year before, just to give you some context. And some of the biggest OEMs in Europe are scrambling to really have Northvolt capacity secured. And we can come back to the reasons, on that. You take something like SpaceX, they now have about 80% of the entire launch market. You go back 10 years ago when that had been non-existent, and then maybe to some smaller names such as Upside Foods, which is a name probably less familiar to you. This is a company who are kind of leading the way in the cultivated meat industry. And what was really exciting for us is this is a company that got FDA approval for their cultivated meat. Now, why this is exciting from our perspective is if you think about meat as an industry, this is a $1 trillion industry, but it's also one of the biggest greenhouse gas emitters in terms of the land and water needed for agriculture. So any ability to actually reduce that impact, and cultivated meat is one of them, we think is very exciting. So I think when you kind of pull all this together, Keegan, and you kind of look at the progress that was made, and I've just pulled out a couple of names there, what we think is that kind of drumbeat of underlying technological progress continues. And then maybe just sort of flipping to the next slide. This is really how we sort of think about the portfolio. You probably heard us talk about this before in the past, but we think there's probably 3 broad themes that are going to drive returns for the next kind of 5 to 10 years. There's decarbonization, moving away from carbon-based energy generation towards electrification and renewables. There's this intersection of technology and healthcare. And then there's, the kind of growing digitalization of the economy there. And I think, again, when you sort of take a step back, when we look at all these themes, whether it's in healthcare, whether it's in the kind of transportation field, whether it's in retail or food or finance or whatever variable you look at, progress very much remains. And so I think with that in mind, as I say, when you come back to our kind of philosophy and process, we're looking at things on that kind of 5 to 10 year time horizon. We're not concerned about quarterly earnings. We're not concerned about the kind of the short-term noise in the markets. In our opinion, the companies that we're investing in are disrupting their respective industries, and these companies are going to progress, whether interest rate rise or fall, whatever inflation does. I mean, you take something like Tesla as an interesting case study. If you go back 10 years, would you say the success of Tesla has been predicated on what the Fed have done or what GDP has done? Amazon and e-commerce, Whatever sort of angle you want to look at, we think that progress will happen when these companies disrupt industries. And as I say, over our investment horizon, we believe that will continue. However, it's not to say that there haven't been challenges. Maybe Simon, just flicking on to the next slide quickly. I've pulled out a couple here, Keegan, just to sort of highlight. I think it's next page. Oh, sorry, next page there. Yeah. In terms of the challenges, there has obviously been some issues with some of our companies, and what I would say is that this isn't a case of broad themes being applied to every company. There's been very specific idiosyncratic risks at some of our holdings. So whether it's something like Carvana, which is an e-commerce platform for selling second-hand cars, they've had some balance sheet concerns which we've been closely evaluating. Illumina, which is the genomic sequencing company, we're increasingly worried about some increased competition there and what that means for Illumina. Competition is not necessarily new for this company, but we are sort of monitoring what that means for the potential to be one of those outliers that we look for. Netflix is another one, probably kind of long-standing name for Scottish Mortgage and our shareholders. Netflix had a tough year last year. Again, we're sort of questioning this new strategy that Reed Hastings has announced, which is this move towards advertising. And the questions we're asking ourselves here, Keegan, is there like a second act, for Netflix? Have they hit saturation point? What are we thinking about competition? So we're asking ourselves a lot of those questions there. And then finally is China, which is probably a slightly bigger conversation. And with China, we've made a number of changes to the portfolio last year specifically. I don't know if it's in. It's in here. Thanks, Simon. So China's probably just worth pausing a minute for, just taking a couple of minutes just to explain what we've done here specifically. I think last year the landscape in China evolved significantly. And what that meant in practice is we had to really kind of think about our alignment, where we wanted to be exposed, and really think about, did these companies still have the potential to generate those returns that we look for? So what I try to say here is that, for us in China, we're not viewing the landscape as one-dimensional. I think that's a really, really critical point. We shouldn't view all Chinese companies in the same prism. And so where we are now with the portfolio, Keegan, is our portfolio exposure has roughly halved in the last 2 years. We're probably sitting around the 13-14% mark now. If you roll back to October 20, the end of 2020, that was probably about 25%. But where our convictions are probably strongest now is in the companies who I would say are most aligned with the CCP and the kind of the direction of travel with the government. So companies like NIO, who are going to play a massive part in China reaching their electric vehicle targets. They're one of the leaders in China and on the EV front. Artificial intelligence is a massive area for China as well. Horizon Robotics, who's a private company, they're incredibly well aligned there. And so any of our new ideas that potentially might come in the pipeline, I would say will be very much aligned, with around the themes of decarbonisation, that kind of digitalisation of the economy. Moving along that table there, where we've been sort of monitoring things a little bit more carefully is on the big platforms. And so we have completely sold out of Alibaba, which has been a decade-long holding for Scottish Mortgage. We sold out in November of last year. We've been trimming Tencent, and we're keeping an eye on the other big platform businesses, Meituan and Pinduoduo. And what I would say there is, in China, the noise that we're sort of getting from our companies is that, in the past, being big was a positive, you know, that scale mattered. But that's changed, and what we're sort of hearing from our founders and our companies in China is that, you know, in the past it was good to be big, but this is now an environment where it's probably good to be small. You know, you don't want to have you know, those tentacles kind of infiltrating, you know, all these parts of Chinese society. And so what that means in practice is that, you know, for companies like Meituan, who's a food delivery company, and, you know, Pinduoduo, who's a kind of e-commerce platform specialized in kind of bulk buying. What we're monitoring here, Keegan, is almost like, is there any impediments to the profitability? Is scale, is the fact that the government do not want these companies to scale and get bigger, is that going to hamper profitability? And really what that means in practice for the outlier potential of these companies. So it's probably an area where we're keeping a close eye on. Pinduoduo is probably in a slightly more favourable position, just because, again, that alignment with the CCP. Pinduoduo are very much focused on the second and third tier cities in China and bringing e-commerce to the parts of the Chinese economy that have been sort of ignored by the Alibaba ecosystem. So bringing all these digital tools to these areas is seen as a good thing in the Chinese government's perspective. So we're obviously keeping...
Jump in there. I think
Yeah.
the biggest question from our side is just around the timing of this sale of, I think, obviously reduction in Tencent and complete sale of Alibaba, given that obviously the whole of 2022 you rode the negative wave.
Yeah.
And then late, well, I think it was around November as the sale actually happened. What was that timing? Was that just what was the decision taken around to actually exit it at the lowest point, basically?
Yeah, I don't think that's, I mean, I don't think that's a deliberate, you know, tactic. You know, we don't try and time, you know, time entries and exits. It's a case of how, you know, what we were hearing from our colleagues. You know, we've got an office in Shanghai who are obviously very close, and get good connections to the companies, you know, on the ground there. I think as well, the one thing to say is that, you know, competition for capital is really high in the Scottish Mortgage portfolio. And so when you had the sell-off in public equities, which we thought was obviously pretty disproportionate to their long-term outlooks, you know, what we were thinking at that point, Keegan, is right, okay, well, we actually don't think that Alibaba and Tencent have got the potential to make that 5 times or 10 times return from here. So do we recycle that capital back into areas, you know, where we do think there's a potential for those returns? And so I think that's that kind of like healthy competition for capital is really important. You know, as I said at the beginning, we've held Alibaba for a decade. You know, up until this point, we hadn't sold a single share of Alibaba. You know, we've been very, very big supporters of it. But, you know, in this job and industry, you can't fall in love with stocks. And so when you reassess the investment case and you can no longer make that upside case, that's the time to take your money off the table and put it into companies where that conviction is there. So I would say it wasn't a timing. It's not a case of we rode the wave downwards all year and then sold out. It was a case of our evolving understanding of the landscape in China. And if I could go back to maybe the middle of the year, it was interesting when we were talking to the founders of you know, Meituan or Pinduoduo or any of the companies. They were saying themselves, like, they were struggling to navigate what this meant for them. Like, they were struggling to understand what this meant for their business. And so if you've got your founders telling you, we're struggling to interpret what this means for our business, as an investor, you're kind of like trying to work out and disseminate, you know, what this means in practice for those returns. And I think obviously as you know, we had the CCP conference and was it the October? I can't remember the exact dates and stuff, but I think we just felt that the narrative had changed, and so that was really the reason as to why, you know, our exposure sort of reflected, you know, what we thought the long-term outlook was there. But as I say, we did recycle, you know, we have recycled capital into some new names. We've been adding to those names as we thought the share prices were disproportionately hit throughout the year. So I don't know, does that sort of answer your question?
Yeah, that's perfect. Thanks, Beth.
Super. It may be worth going back on the slides, Simon, a little bit and just touching on the sort of the private companies, Keegan, because I know it's an area of just that slide there. That's perfect. So obviously with Scottish Mortgage, Keegan, as you know, we have this 30% cap of our exposure to private companies. The next slide, which you can just see on your handout there, shows you we've just been at or around that 30% level roughly all year. And what I would say is there's always these three factors that determine that exposure. There's a number of new companies that we buy that are private, which obviously takes the number up. If we're buying more private companies, that elevates that number. There's the performance of the public markets relative to the private markets. And then finally, there's obviously the number of companies that are choosing to IPO or go public, which takes that number down. So obviously reduces your private number. And so what you can see in these sort of charts here, Keegan, is that in 2022, that completely ground to a standstill. Because of the market backdrops, any companies that had plans to IPO didn't. Second of all, there was no companies obviously wanting to raise capital, in down rounds, having a lower valuation than the previous one. So one of the naturally offsetting factors for us with that 30% limit has almost evaporated. So when you're looking at that kind of 30% limit, I don't know, Simon, if you can just sort of scroll down the chart that's on the next page there, you can see there, Keegan, how it's just been sort of hovering above and below that line. Now what I should say is that when we're above that dotted line, when we're above that 30% cap, that doesn't mean that we have to sell any companies. It doesn't mean that we're forced sellers. It just means that we cannot participate in any follow-on funding rounds, or we can't buy any new companies. And so, but from our perspective, that's actually been okay. Because public equity markets, especially growth stocks, are obviously hit so hard, and the whole space was almost disproportionately hit. We were finding opportunities, to top up some of our highest conviction, ideas in that space. So I don't know if that sort of helps in any sort of put some context around our private company exposure as well.
Thanks, Kate. I think the question as we get from clients is basically, obviously there's been a huge downturn in growth stocks and obviously tech heavy, and obviously Scottish Mortgage was hit because of that. And there's a concern around the re-rating of these private companies. I know you guys are quite good at rating these companies and do it quite often. I'm not sure if there is a concern of a second downturn, possibly due to the re-rating this year.
Yeah, so what I can say is that, I'll maybe send it to you after, maybe Simon can send it to you after this call, Keegan. I've got some information on just how many revaluations that we did last year, and it's very, very different to like general sort of private equity, the process. So to give you some sort of context around how much we've written our companies down by, we performed just under 500 revaluations throughout 2022 over the kind of 80 odd instruments that we hold. So what does that mean in practice? Those are just numbers, Claire, but basically about 70% of the portfolio was valued more than 5 times. Every company in the portfolio, every private company in the portfolio, so 100% of the private company portfolio was revalued more than 3 times. And so what that hopefully shows you is that, we are trying as hard as possible to ensure that the value that's reflected, in our NAV is as close to fair value as possible. We don't want to have stale prices in the portfolio. And that really shows you the fact that we performed so many revaluations, and the write down, you can see there on that chart there, the average write down of a Scottish mortgage company was about 44% last year. That NASDAQ numbers, what does it say there? 33%. Sorry, just my eyes are trying to see that number there. But what that kind of shows you, Keegan, is that, we have written our private companies down, whether in line or slightly more than the market. So if you look at some of our, maybe I wouldn't call them peers, but if you look at other private equity funds, they don't necessarily revalue companies on as frequent a basis. So there is more stale prices. There is probably another leg down for a lot of these companies. But because we have this you know, I won't say continual revaluation process, but we have a private company valuations team who are looking at these things daily. And if there is any change in, let's say, the public equity peers of some of our private holdings, you know, they'll assess it, they'll revalue it and see if there's any change to, you know, to the value that we're holding for it. So hopefully those numbers there kind of show you, Keegan, that, you know, what we've done is the average write down of our holdings. The other number there, that 34%, I should say, includes the companies that were written up as well. So that's the kind of average, if you like,
Okay.
of all the companies, because I think it's also important to note that, you know, you shouldn't view, you know, private companies as like this blanket asset class. You know, each company needs to be evaluated on its own merits. And so I mentioned at the top of the call, you know, companies like SpaceX and Northvolt, just to take two examples, you look at the progress that they're making, you look at the strength of their order book, you look at the pipeline, you look at the cash generation, whatever you want to look at, you know, that's obviously reflected in those companies' valuations. So it's not a case that, you know, all private companies have been hit hard. There obviously are some companies that have continued to perform very well.
Cool. Thanks.
Super. And so maybe just like just maybe a last slide, which I think is page, is it 9? Simon there, and can open up for more sort of questions. Is that I think again, sorry, I think it's the next one, that one there, yeah. I thought this was kind of an interesting sort of like prism in which to look through what's happening right now. And it's again coming back to the kind of what's the first principles of Scottish Mortgage? What is it we're trying to do for shareholders? You know, we're trying to find the most exceptional growth companies in the world and hold them for long enough so obviously the returns that generate from those companies accrue to shareholders. And so what we're doing is we're looking for innovative companies. We're looking at companies that can disrupt big industries, and the companies that we're investing in, you know, can really kind of go on and dominate. And I think when you look back, you know, over the last kind of 40 years or so, if you look at various fields, whether it's retail innovation, you know, it wasn't the incumbents, it wasn't Walmart, it was Amazon. You know, in media, it wasn't CBS or Warner Brothers, it was Facebook and Twitter. In the automotive market, it wasn't VW, Ford, or GM, it was Tesla. You know, in space, you know, it wasn't Boeing or Lockheed Martin, it was SpaceX. So you look at disruption, and you look at who's been the disruptors in these sectors, and it's been these new companies that have come to the fore. And so I think when we look ahead, you know, when we look at areas like healthcare, you know, we think Moderna has the potential to be probably the first $1 trillion pharma company, because this is a company we shouldn't really think about as a pharma company. We should probably think about it more like a software company. You know, you're designing drugs in a computer, and that's scalable. And we've never had scale in the healthcare industry before. The healthcare industry is one of those weird industries where you probably have diminishing returns to scale. You know, the success of one drug doesn't tell you about the success of another drug. You know, there's no correlation there. Whereas what Moderna have obviously done with mRNA is they've proved the technology works. They've proved that this can work. And so now it's just about really applying that to other areas. And as I say, if you look at, you know, what Moderna have right now, you know, they've got, you know, 4 drugs in phase 3, 9 in phase 2. You've got 48 drugs in the pipeline. You know, this personalized cancer vaccines. You know, this is exciting. You know, from a healthcare perspective. You look at something like logistics, which is, you know, another area which could be, you know, so exciting from our perspective. You know, we don't think it's going to be FedEx or UPS. We think it's going to be Zipline, which is a drone delivery company. And we think that is really the future of logistics, and we think Zipline is probably, you know, very well placed to capitalize on that. And then in food, as I mentioned, kind of Upside Foods, the company that are leading the way in cultivated meat. And so I think, again, from a Scottish Mortgage perspective, you know, we can look at the short-term noise, we can look at, as I say, what inflation's doing or not doing one month to the next, what interest rates are, you know, what direction of travel is there. But this is about disruption. We're looking at companies that are disrupting industries. And I think it's important just to sort of look at Scottish Mortgage, you know, through that you know, through that window, that is really what we're doing. That hasn't changed. Nothing's changed in our philosophy or process as a result of last year. And I think the message to probably take away is it's very much business as usual in terms of what we're doing. You know, we're continuing to look for these types of companies. We're continuing to meet with founders. You know, we're just, as I say, there's been no change to that kind of philosophy and process despite a very, very challenging year.
Thanks, Claire. And then Claire, just on as well, I know the high gearing obviously of the fund magnifies the returns.
Yeah.
But also can exacerbate obviously the impacts of any further market downturns. Are you guys concerned about that, or?
Yeah, I mean, obviously the gearing is one of those things that if you look over the last decade, I would say, Keegan, it's probably hovered around the 10% mark. And that's not been a deliberate target. There's nothing set in stone from the board or in the annual report to say that's our gearing target, but it's been roughly, if you eyeball the number over the last decade, that's roughly where it's at. What happened in 2021 is because we had this huge performance year. You know, performance was just as we would caution against, you know, too much pessimism this year. We probably cautioned against too much optimism in 2021. But when we had that year, when obviously the performance was up, you know, phenomenally, the gearing came down massively. So the gearing came down to about that kind of 5-6%. So what we did was, you know, to take advantage of very, very low interest rates, you know, we secured sort of 25, 30-year private placements at like between 2 and 3%, which is, you know, in hindsight, it wasn't deliberate and it wasn't like a strategic decision, but we were obviously just trying to take the gearing back up to that kind of normal level, if you want to call it that. And then what happened is obviously the markets moved against us. So that obviously then made the gearing look higher than it was. So again, I think it's best to view the gearing through the prism of when you see what's happened, obviously, with the market. It's not been a case of we've been trying to time it in any way, shape, or form. It's just been a function of, you know, what the performance of the overall trust has done and where we were there. But as I say, when you do look at you know, when you do look at the performance in those sort of 2020, 2021, the gearing was obviously lower than that kind of average level. But we do monitor it. You know, we have loads of mechanisms in place where we can monitor any sort of risk factors around that, and you know, we've got more than ample headroom, you know, from that perspective.
Perfect. And then just the last question from our side, obviously, given the current discount to NAV, has
Yeah.
Scottish Mortgage bought back any shares? I'm sure you have.
Yeah, we have been. What I would say on the buyback is that in terms of our policy, Keegan, you know, it's very much around operating the buyback in kind of normal market conditions. And so what I would say is that in days where you're just seeing indiscriminate selling, that is, in our opinion, not a brilliant use of shareholders' capital, going in and buying back shares when you've just got a wall of probably passive basket sellers. You know, what Scottish Mortgage has been caught up in quite a lot is because we're a FTSE 100 constituent, you know, we're obviously caught up in basket trades of a lot of global funds dumping FTSE 100 stocks. And so a lot of the sort of trading patterns have been around that kind of passive selling in the FTSE, and we're just, as I say, we're just being caught up on that. So when we're trying to use the buyback, we're trying to make sure it's effective because, as I say, we are using shareholder funds for that. But no, we have been using, I think we bought back about 200,000 shares last year, give or take, was roughly the number, I think. But yeah, so we are active, we do it, but it's not a case of, we don't want players in the market to try and guess what we're doing. Do you know what I mean? Because they can obviously try and arbitrage where we're buying back at what price. And so we're really trying to avoid that scenario as well. But what I would say, Keegan, as well, is in terms of the discount, when you actually look at trusts in the UK that have private company exposure, I think the kind of average discount of those trusts are around the kind of 40% level. You know, I think anything that has private companies sort of attached to its philosophy has been really hard hit because of obviously worries around the revaluation. And hopefully what we're trying to do is speak to our shareholders and clients and explain that our process around our private companies are different. You know, we don't have these stale prices. We are constantly revaluing. You know, that number I said to you earlier, like just under 500 revaluations during the year. You know, I don't think you'll find many other trusts with private company exposure with that number of revaluations. You know, 5 times, 5 different revaluations of some of these companies. You know, we are really trying to make sure that the fair value of these companies is reflected in the NAV. But I would say the whole sector, you know, in that space is really out of favour right now. And again, we're sort of caught up in the crosshairs of that.
Perfect. Thanks so much, Claire. That was
No
great
worries.
and insightful. Yeah, thanks, guys. Thanks, Simon, for as well setting it up.
I would say as well, Keegan, I don't know if you're aware, but we have a new Scottish Mortgage website now where we've got a lot of information
Yes.
on that.
Yes, it's great.
We also have LinkedIn channels now, so we're actually putting a lot of content out, you know, so in terms of trying to keep our shareholders more engaged with what's going on, what we're thinking, you know, we've got a few new tools just trying to help with that kind of engagement and communication side of things. So feel free to have a look at
podcast as well.
Yeah. So that's been really
great.
good. Yeah, and again, it was interesting. I was speaking to one of our Canadian colleagues who's in the office this week, and he was saying that it's been so nice listening to them because, again, it sort of takes you away from just the noise of what's going on every day, and just like listening to these founders who are addressing these massive problems. So I did the one on Friday night with Upside Foods founder, a guy called Uma Valletti. Zipline, the founder of Zipline is a guy, Keller Renado. I would really encourage you to listen to that because it's honestly, it will blow your mind in terms of what they're doing. So yeah, hopefully it's something else for our shareholders just to sort of feel like they kind of get a bit more granularity on some of the companies we're investing in.
Yeah, I think obviously every day is a new noise, and when the market goes down, then everyone's panicking. When it goes up, it's a bit too soon, and as a whole, too much noise at the moment. So it's kind of good to get a perspective of just we want good companies here. Just let's carry on and do it.
Yeah,
let them do it.
Maybe on your walk to work, take 40 minutes out and listen to them and see what you think. But yeah, if there's anything else, then but yeah, feel free to let us know if there's anything else we can do.